This panel is otherwise titled Everything That Foster and Baji Didn't Get on the Agenda Yet Today. We're going to talk about in this 30 minutes. We're going to be trying to be super quick. I don't have the kind of poll that Frank does with Zach, aka the bouncer, so we'll try and plow through a bunch of questions. And I want everybody to introduce themselves. We'll start off with the first question and then give a quick line about what you're doing, and then we'll go from there. I don't need to remind this room of crypto's deepening correlation between macro factors. It's arguably become a hedge against inflation, but also vulnerable to downturns in the global markets. We've got crypto M&A on pace to hit 12 to 30 billion this year, depending on whose estimates you look at. Either way, that's 5 to 10x over last year. Venture into projects has surged by 57% this year to over 15 billion. And digital asset treasuries, which is also on our agenda, have raised north of 20 billion to a culmination of an estimated 133 to 200 billion across 100 different publicly traded entities. So, starting with macro, I want to get each of your broad takes here. If you look at U.S. tariffs impacting supply chain and how central banks are responding to that, macro factors such as the U.S. dollar and emerging market instability, and monetary policies such as quantitative easing and rate cuts. So if we take all of that into consideration, Ben, let's start with you. We'll go down the line, give a quick intro and how those factors are impacting your business today.
Yeah, so thanks, Kelly. Ben Forman here. I'm the founder of ParaFi Capital. We manage a little over 2 billion of AUM across liquid, venture, and quant strategies. Have been in the space now for 10 years, launched ParaFi 7 years ago. I think this is like my 5th RWA summit. And it actually feels like this is the largest and there's the most momentum. So it's good to be here. So macro, look, like my overall take is that crypto is a secular trend, like things like tokenization, stablecoins, DeFi, regardless of what happens with interest rates, regardless of what happens with China, like these things are going to work, right, over a 5 to 10 year time frame. I think macro really matters. Like if you have a 1 day to like 6 to 12 month time frame, but as you go further and further out in terms of your time horizon, I think it matters less. Now, look, like I would say crypto from a macro standpoint is, I believe, like better positioned than it ever has been as an asset class. I mean, if you kind of like do a quick kind of temperature check on crypto capital markets. Today, liquid digital assets are a $4 trillion market. If you strip out Bitcoin, which is $2.5 trillion, that's $1.5 trillion of other. That number is about the same as it was in 2021, 4 years ago, despite all the fundamental progress that's been made. There hasn't been growth there. So if you just look at the fundamentals, if you look at the M&A that Stripe's been doing, if you look at Robinhood Chain, if you look at Fidelity kind of rumored to launch a stablecoin, if you look at the ETF flows, and you were to say that like crypto market cap ex Bitcoin is the same as it was 4 years ago, like you'd be like, no, that doesn't make sense. But that's the reality. So I'm quite like, I would say just overall bullish on where we are. And then last thing, if you look at crypto IPO markets this year, there have been 4 crypto IPOs, Circle, Gemini, Figure, and Bullish, all 20x oversubscribed. There's significant institutional demand to own the companies that are, the rails for tokenized securities for stablecoins. So there's a lot to be excited about, but I'll pass it to the expert over here.
Also, I agree with your comments. I think that's right on the mark. Just briefly, Ahluwalia, I lead Lumida. We're a digitally native SEC-registered investment advisor. So our thesis is that 60/40 is dead. You need alternatives. Digital assets play a role. People don't want their advisor taken to the US Open. They want to take their friends and family to where they want. Community matters. They need a digital UX experience. And so we're on-chain, we're off-chain. We do digital assets, public equities. So, the big picture, I think tariffs are a rear view mirror. Markets are looking forward. Is there a negative impact of tariffs? Yes. Where? Small businesses. Does that matter for public markets? No. Why? Because small businesses aren't publicly traded. The largest components of the S&P 500 and the QQQs are the Mag 7 companies, and they're resilient to tariffs. So that's one. That's really a nothing burger. On the DATs, I think DATs represent a bid for spot market assets. You can just front run the DATs. The DATs are doing at the money offerings, diluting their shares, and they're going to go buy Ethereum, and they're going to buy Solana. I do think the DATs have been a bubble. It would be interesting if a year from now that some of these DATs trade below MNAV, and then you get a repeat of the grayscale GBTC, ETH trades that I know we did a few years ago. But overall, things are good. You've got record earnings growth, record year-over-year earnings growth, 12%. You have productivity growth that we haven't seen since the late 90s when another technology, the internet, was coming online. And now you're seeing more broad-based AI adoption. That trend is not going to stop anytime soon. So what we're seeing is positive ROI from the hyperscalers, and financial services companies are adopting this. So I think you should be bullish. The next quarter, the next 1 year, asset prices should be higher.
Hey, everybody. I'm Henri Stern. I run a product called Privy. We build wallet infrastructure. So we help everything from fintechs, neobanks, to hold assets in-house as part of their own treasury management, as well as developers leverage wallet infrastructure to build products that use digital assets in-app. We are part of, M&A's and Stripe's recent M&A strategy. Privy was bought by Stripe a few months ago. And so we operate the business now as part of Stripe. I think my views on macro are mostly micro views, which is to say most of my time is spent with developers who are building in the space and seeking to leverage these tools. So I guess the main thing that we're seeing on our side is kind of an interesting meeting point of call it supply and demand as pertains to yield generation on chain. I think as we see interest rates change, there's much more institutional demand for on-chain yield and other sources of yield, and that's driving people towards DeFi, including traditional fintechs. And so we see this every day with the tooling that we build for fintechs, which is demand for products that will enable them to reach new sources of yield and sort of capital efficiency for their products, including on the other side, systems backed by the folks at Apollo, BlackRock, and so on. So that's the really interesting convergence that I think we're seeing building out what we do. We're very much kind of at the frontier with the developers that we serve, but we're seeing a lot more institutional adoption of these tools, either on the supply or on the demand side, to build with sort of global yield in mind, as opposed to call it localized yield rails in the US or anywhere else.
Ram, your clients, how are they stress testing against a recession that might come?
Many of our clients created wealth investing in digital assets, Bitcoin or Ethereum or Solana, and they've lived through cycles. So one comment yesterday is quite interesting. This individual poker player, quite a few poker players, by the way, created wealth in digital assets. Fun fact. And he said, this is my third cycle. I sold my Bitcoin at 123.7, probably top ticked it. He's very good at what he does. And they're starting to rotate into other asset classes. Actually, we're teaming up together to go acquire a bank. Talk about diversification. I think this will come up later in the conversation. If you think about what it takes to bring assets on chain, what is tokenization? Tokenization, another word for securitization. That's what it is. The issues have been that there's no framework to bring an asset online, because to bring an asset online, you got to make it available to the public. And if you do a public securities offering or public tokenization offering that's permissionless, you have to file an S1 with the SEC. That's called an IPO, or you filed a Reg CF. So banks have these exemptions from securities laws. Think about it. A certificate of deposit meets all the criteria of a Howey test. You rely on the efforts of others. There's an expectation of profits. You invest in a common enterprise, and it's marketed to the public. It's a security, but why is it not regulated by the FCC? Because they're governed and regulated by banks. So I think there will be a lot of devastation for these small community banks. They're going to get taken. The stable coins will hurt them. But there will be these niche, hyper-specialized banks that intermediate, match buyers and sellers of risk, buyers and sellers of dollars in tokenized and fiat formats, and they will be these trusted bridges between these two worlds. So I think that's a thesis that we have here. I don't think people are talking about that. I think it's a very compelling thesis, though.
Let's bring up stablecoins in the context of macro trends. Stablecoin volumes just surpassed MasterCard and Visa. Ben, I look to you. What does that mean? Are stablecoins the new risk-free asset?
Yeah, look, I think that like the growth of stablecoins like is the single biggest story in crypto, and I think will continue to be because tokenizing assets are one thing, but the dollar is such an important geopolitical primitive. The U.S. dollar is the most popular consumer product in the world. People don't think about money as a consumer product, but it is, and it has massive network effects. And so, the U.S. dollar, and stable coins are, like just an incredibly important initiative for our country to ensure we maintain U.S. dollar hegemony on chain, just like we have it, in the Web 2 world. Look, as far as is it the new risk-free? Are stablecoins the new risk-free rate? I think that's almost like a different question in the sense that rates on chain, the risk-free rate on chain is actually lower than what you can get off chain in many cases. If you put your stablecoins on Aave, you're earning, I think 2%, 3%, versus you can earn, 4% and change on Web 2. So, one question is, well, why would anyone leave their stablecoins on chain and earn less than they could earn off chain? Well, the answer is that people love holding stablecoins and they don't want to off ramp back into the traditional economy. That's just I think an indication that this has incredibly strong product market fit. If you actually, you're giving up dollar return to stay on chain.
How do you see tokenized deposits competing with stablecoins? Obviously, they're FDIC insured, but you have to KYC, unlike a stablecoin, which is borderless. Do you see tokenized deposits competing in that area?
Yeah, we were kind of talking about this previously. So if you think about stable coins, you have M1 and M2, right? So I think one of the interesting things about stable coins are if you compare it to a dollar in a bank account. If you have a dollar in a bank account, let's assume it's not with a SIFI, right? You basically are a creditor in a levered financial institution. Right? If you have a dollar with a dollar in your checking account, it's not like they're sitting there with a dollar ready if you go to go to redeem. Maybe they have 10 cents on the dollar, right? The rest is being lent out, and they own high yield bonds and investment grade bonds and private credit. But if you think about a stable coin, it's fundamentally really different, right? You have a claim on a U.S. Treasury, one-to-one collateralized, held by, in a bankruptcy remote entity. And so to me, that's a much safer form of money than a demand deposit, a checking deposit that we tend to refer to as money in the traditional system. So I think look, I know JP Morgan's tokenizing bank deposits. I think that's a very different instrument than USDC today. And last thing is we were having the debate a few years ago in early 2023 when you had the kind of SVB banking crisis. And the debate we were having is, would you rather hold a dollar at a community bank or one USDC? And the beauty of holding USDC is about, at the time, about 70% of USDC's reserves were treasuries, custodied by State Street, managed by BlackRock, and then another, the other 30% were held by banks, and they were distributed across multiple banks. But I think, and they have to do that in order to satisfy redemptions. They can't be 100% in treasuries. But just from first principles, I would argue that a stable coin that's collateralized completely by treasuries is just much, much safer than a checking deposit.
The thing I think that is worth mentioning as well is where is the stable coin being purchased, and what is the alternative? At least I think what I'm seeing is a lot of US and generally sort of Europe-based stablecoin usage is B2B rather than B2C. And consumer interest in stablecoins mostly comes from countries where it's about purchasing dollars rather than a safer deposit method. So if you look, I think, Tether is 60, maybe 70% of stablecoin AUM today. And Tether's a 0-100 hedge fund. Like, people are not comparing it to the 2% they can get from traditional markets. They're comparing it to like holding, Naira or another currency that they broadly are going to see like have devalued over years as opposed to dollars. So I think that'll be the interesting thing to watch as well over the coming years with, for example, Tether launching USAT, is how does, call it Western or American, Western European adoption of stablecoin diverge from the rest of the world that seems to be driving a lot of demand.
Yeah, no, I think there's going to be more evolution, and it's too early to call winners. Like, stablecoins pay zero interest. They're subject to inflation. They're issued by non-bank. You've got implicit counterparty credit risk in there. I think the international use cases are compelling. Obviously, USDT is the most successful stablecoin issuers is solving that problem. But beyond stablecoins and beyond tokenized deposits, right, which I do think will make an impact, right? Anyone transacting with Amazon, or think about all the implicit working capital tied up in net 30, net 60 settlement, people are going to want to earn interest, and we're talking massive numbers that are not earning interest if stable coins the form of payment or storage. So the extent stable coins use, it'll be temporary, finite, atomic. Then people want to get interest-bearing assets, especially if you're a large e-commerce company or a digital media company. But what are the other things that get tokenized reserves? Tokenized reserves is really the holy grail. If you're Google, you take FDIC insurance at $250K, you exceed that right away when you get $80 billion. You try to buy treasuries, you got to park it. You park it at JP Morgan, they're the safest bank in the world. You're still taking credit risk in Google. What you would love to do is have a tokenized reserve. What that means is you have a tokenized reserve issued by a bank where your token is 1-for-1 matched with a deposit at the Federal Reserve. Now you have the safest instrument in the land. I think that is something to consider. I don't know if people are doing that. This is the concept of narrow banking wrapped with tokenization.
The use cases that you all are talking about are much more real, and they're much more long-lasting. As we tie off on sort of the macro conversation, because I want to get into stats and M&A. Do you think the crypto cycle, we're still in a 4-year cycle? Are we following something else now? What's your take on that?
I will go first and say, fucked if I know. I think broadly, I suspect that no matter how hyped stablecoins are, they are deeply underhyped. I also think there's probably an assumption that some of the infrastructure is more well-baked than it is. I think off-ramping globally is still very much a work in progress, and like partner banks on actually moving stablecoins back into fiat in places where it's relevant is still something that needs to be built out in a huge way. So I assume there will continue to be, some volatility in the short to medium term around these markets as people are broadly speculating on their utility. But I think the fact that there is a utility and the fact that the utility is broadly still majorly untapped and that actually we can do so much more with these tools than we are doing today is true. So I think the long-term view is extremely positive now, whether there are, cycles within it.
Go ahead. Yeah.
I was just going to say, like, are we in a 4-year cycle? Well, I think we're not. I would say, first of all, the whole 4-year cycle meme has like an N of 2. There was like a run up in 2017, a run up in 2021. I mean, it's like it's a very small sample size. Now, I think this is like a weird market for spot crypto. Like Bitcoin's up like 20% year to date. Solana's up, I think, like 10%, but it was just down like up until like a few weeks ago. A lot of the top 20, 30 assets are down meaningfully year to date. L2s don't have a bid. The application layer, like things that have product market fit, like Hype has, is up 100% year to date, or Syrup is up 200% year to date. But plenty of other application layer tokens are down 80, 90% year to date. So there's meaningful return dispersion in the space. In prior markets, you could just kind of like throw darts and like everything kind of traded together. In this market, like asset selection is paramount. The other thing is volatility is very low. Like if you look at like implied vol on like Bitcoin and ETH and just like broadly the space, like it's the lowest in memory. I think there's a lot of structural vol selling on the ETFs. The other thing are DATs. I think DATs have been the marginal buyer of spot crypto this cycle. I think now about 4% of all Bitcoin is held by DATs. About 2.5% of all ETH is held by DATs. Approaching 1% of all SOL is held by DATs. Without the presence of DATs buying spot crypto, I do wonder where prices would be. So it's a weird market. Yeah. But I think the 4-year cycle is totally dead.
Yeah, no, I agree. Like, these markets are no longer segmented. The reason why all assets correlate to one is because markets share margining, sources of liquidity, prime brokerage. And now with Bitcoin and Ethereum and soon Solana in ETF format, they're going to correlate with other beta. So yeah, the 4-year cycle, I think, is less relevant. It doesn't mean that Bitcoin, which has this kind of strong concept of that cycle, it doesn't mean it doesn't trade off in November anyway. But I think the bigger things to look at is what's the direction of interest rates. I don't think we're going to 1%, but if that's the direction of travel, that's going to be very constructive. The other part is we're in a momentum market now. This is momentum market. You've got Palantir at 150 times PE ratio. You got whatever Tom Lee talks about starts going up. Like, this is the kind of market we're in. It's like early 2021 vibes, I want to say. So, but we're not at those levels of excess in valuation. We still have the IPO season that's running. Like, the thing to watch for would be broken IPOs and bad IPO deal quality. We're starting to see some of that. These companies are making money, which is good. The proliferation of DATs is not a great signal. But we still have more quality IPOs to come, and we haven't seen the animal spirits that invigorate the markets break yet. And that's supported by constructive policy, fiscal spending, and lower rates.
Let's double click on DATs for a minute. DATs were some of the best performing things in crypto a couple months ago, and now it's sort of the alts, and even Bitcoin mining is outperforming. The sort of strength is further out on the risk curve. Where do DATs go from here? Ben, I know you've done a lot of them at ParaFi, or Bitcoin, ETH, Sol are kind of exhausted. What else are we going to see from here? It's later innings in the U.S. Maybe is it still early outside the U.S.?
Yeah, I was just thinking it's kind of ironic because like everyone in this room is trying to take traditional assets and put them in the format of a token, but DATs are the inverse. Like it's taking a token and putting in the format of an equity. So it's a little bit ironic to be talking about it right now. But yeah, look, like I think that DATs are like something that like people like. It's very polarizing. Like a lot of people, like it really bothers them that DATs exist. I just think DATs are simply financial wrappers. And the reality is like equities are still the king instrument. Like equity markets are still where all the liquidity is. And
well, didn't Bank of America just this afternoon, like 86% of people, like fund managers, have never touched crypto? Like there's still a lot of potential there. They could touch a DAT, right?
Yeah, exactly. They can touch a DAT. And the ETFs, I guess, work for some people, but some fund managers can't own ETFs. Like they want it, but that's part of the reason why strategy got all the traction that it did. But look, I think we're in like the 7th, the 8th, or the 9th inning of this first wave of DATs. The first wave being like all these pipes that have gotten done this year on, the Bitcoin DAT, the Sol's DAT, the DATs. And I don't like, do we need like Ethereum DAT number 11? No. So I think what you're going to start to see is consolidation. I think the market can maybe support 3 or 4 DATs for like the large assets
per jurisdiction.
Within the U.S., okay. I think there will be other DATs in other markets where there's more captive capital, like Metaplanet being one example. And then look, if you're like a top 30, like most top 30 tokens have kind of like have a DAT at this point, or will have a DAT very soon. But I do think there is like a cutoff from like a liquidity market.
What do you think they start doing to keep themselves interesting? Are they acting like foundations? Are they doing more diversified, like DeFi participation, yield staking?
Absolutely, yeah. Like so, I think like the first phase of DATs is asset accumulation. Just maximize SOL per share, ETH per share, Bitcoin per share. The next phase will be. One, you'll continue to do capital market things. You'll run your ATM when you're above NAV. You'll do buybacks when you're below NAV. You'll issue converts. You'll issue preferreds. But the next phase is actually like, can you support your ecosystem? So, Forward, which was the Solana DAT that was led by Galaxy, Multicoin, and Jump, is actually like aiming to be like the most on-chain public company in the world. So they're taking all their SOL, they're interacting with DeFi, they're tokenizing. They're going to tokenize their equity. They're going to, do payroll with stablecoins. So they're going to kind of like dog food a bit in tokenization and stablecoins and support the Solana ecosystem. So I think that is kind of the direction.
I'll disagree a bit here. Just keep it interesting.
Yeah.
I think the main value a DAT creates is generating meme potential and attention. These are attention assets. There's a reason why MicroStrategy and Michael Saylor are paired. There's a reason why Ethereum and Joe Lubin are paired, or Andrew Keys. There's a reason why Solana and Kyle Samani. Those are the kinds of leaders to look for. These are attention assets. If they don't trade at a premium to NAV, they can't do all the operations you're talking about. So I think there will be one major DAT per asset per jurisdiction.
Okay, so we're going to see some DAT M&A. Let's move on to M&A we only have a couple of minutes. So far this year, we've seen 3 times the number of M&A deals that happened last year. 88 deals worth over $8 billion. Year-end projections are as high as $30 billion. Coinbase and Deribit at $2.9 billion. Kraken, Ninja Traders at $1.5. Ripple and Hidden Road at $1.2 billion. Privy and Stripe for undisclosed amount. Henry, you want to comments? None. Okay.
Thank you.
So where does that go from here? Henry, you've been a part of this. You sold to Stripe. What lessons from that deal did you learn that could apply to M&A as we might see it for the next 12 to 18 months in the crypto space?
Yeah, I mean, I think it's really interesting. One, there's going to be a lot more consolidation, and I think, insofar as there is a 4-year cycle, I certainly think 4-year cycles apply to like VC funding. And you had a number of companies get funding in 2021, 2022, who are going to have to start looking for exits. And so you will see basically a wave of people who are saying, today I have 2 choices: I can raise or I can sell, and I should pick one of the 2 paths. Otherwise, what am I doing here? And so I think we'll just see a lot more over the coming year, if only because there are buyers waking up to the fact that this is an industry that they want to be a part of and help build and shape, and because there are ready companies with or without traction who have built interesting technology and need a way to distribute it or augment it or what have you. So very clearly, I think we're just getting started in a sense. My question is is the purchase in a sense about building something new, or is it defensive? Is it about trying to make sure you're not left behind, or is it because there's a way in which this can help shape or reshape your business? And at least one observation that I have that I find very interesting is that stablecoins is the first time that crypto plays to incumbents. I think until now that maybe like Crypto Cope, when looking at AI, was like, well, crypto is the only asset class that is sort of birthing an industry ex nihilo, where AI plays to data moats and plays to existing distribution moats. I think stablecoin kind of changes that, where stablecoins play to existing players' strength who already have distribution, who already have assets that are moving through. And so the interesting thing will be to see what is the thesis behind the broad set of acquisitions. Is it consolidation around, I want to build a financial stack on these rails and I need wallets and orchestrators and issuers? Or is it on the more crypto native side around how you do asset management broadly and so on and so forth? So I think there's interesting things to look at, and we'll see a lot more of it.
Do you think that these larger fintechs can buy their way to stay ahead or get ahead or be ahead?
It's a really good question, at least where I feel great about what we're doing, but maybe it's self-serving. It is in finding the right sort of long-term thinking partner who's actually investing in the space in deep, thoughtful ways and for a long period. So I suspect some of these M&A deals will be the death of the companies involved, at least the smaller ones, in that it will be a way to, I can't help but think if I were looking at public market valuations of companies involved in crypto today, it seems like crypto is a positive thing to talk about as a public company. And so I have to assume there's some people who are looking at end of quarters and thinking about this sort of stuff. But my take is, will the company actually be able to invest over a duration to make good on the strategy that they're trying to pursue? And I think some of them will and some of them won't. So the answer is, depends on the acquirer, but they'd better be prepared to keep investing in the space and actually pursue the work. And I think we're just getting started with what we have to do.
From M&A of this sort of magnitude,
Look, first thing I'll say, Lumida is not for sale unless the price is right. But look, I think, first off, real businesses are getting bought. Hidden Road is a real business, prime brokerage. Did XRP have a real business? No, had a narrative. They bought a real business. The second thing is the hangover from 2021 vintages where valuations were too high. Fireblocks had a $7 billion valuation, Falcon X7 $1 billion valuation, Talos, insane valuation. I don't think assets like that will transact. So you got to have real business and you got to be priced correctly.
does this impact how you advise your clients, knowing any ripple effects?
We're doing pre-IPO deals. We invested in CoreWeave and in Kraken. We're trying to anticipate public markets exits with a 1 to 2 year lead time, so you get long-term capital gains, and you get a private market valuation.
Ben, 30 seconds on what M&A means to early stage venture.
Well, I think the best catalyst for M&A is like a robust IPO market, because when companies start to go public, then like all the potential suitors come out of the woodwork. I'm very fascinated by the psychology of like the buy versus build decision. Like Stripe bought Privy and Bridge. Could they have built that themselves? How do they value those businesses? So I think that is like a really interesting question, because you could have M&A, but if it's not great outcomes, I mean, Privy and Bridge were great outcomes, but you could have M&A if it's not a great outcome, like maybe it doesn't matter as a venture investor.
Great. Thank you all very much for joining this, and thank you guys for being a part of our panel.
Great job. Thanks, Kelly. Thanks, everyone. All right. So, look,